I'm delighted to say that David Mann is joining us now, Chief Economist for Asia-Pac at Mastercard. David, wonderful to see you, sir.
It's great to be back. Thanks for having me.
Is a soft landing guaranteed when you consider what the leading indicators and the earnings have been telling us?
Well, I'm always reluctant to say anything in life is guaranteed, including the outlook for any particular economy, and certainly the global economy, or US, or indeed Japan, China, or the rest of the Asia Pacific. But all of the signs that we're looking at right now, after all that time we spent being so resilient, do suggest that there are some chinks in the armor, a few cracks showing here and there, not enough in our view to suggest that there is anything other than a soft landing that's actually coming. And in that way, we should be seeing some easing off of the inflation data at a time when also there's still some resilience in the consumer spending numbers, as you alluded to from just mentioned in the Walmart data, for example. So around the world, we think we will see the easing off of inflation, still having some growth, though a bit softer than it had been in the post-pandemic rebound years. And that's all, in our view, a constructive way of getting off what had been an extremely disorientating time for central bankers, all policymakers, for business investors themselves, thinking about what's actually coming next, because it has been so disorientating. But getting the inflation complication out is actually very good news for the longer term. We think the last few years were just not normal. They were not the time to be joining dots together and saying that's what inflation especially will be in the future. Instead, we think it will be a much easier, lower pace of inflation because of multiple long-term demographic trends, for example, being the biggest single ones, which means that it should be an easier time for understanding what's coming next, and also a less complicated time for policymakers.
The issue, though, is whether we are not seeing material deterioration in the labour market, particularly after that 4.3% unemployment print in July payrolls. Does that warrant a 50 basis point cut in September? Because that narrative is still floating around, or would that panic the markets and everyone?
We see big moves as being, or speculation over big moves as probably an overdone story. Instead, actually, as we see in other parts of the world too, in Asia Pacific and Australia, for example, there are signs in most places of some softening in the labor market, and certainly there is in the US as well. But the key thing I would stress is we're coming from ultra-tight situation in the labor market to something less tight. So it's very different to be going from such record low levels, or close to record low levels on the unemployment rate, back up fairly fast. But then it's all about, does it continue persistently going up as much? At that point later, if we're, say, well north of 5% and still heading much higher, that would be a different sort of scenario. Same thing in Australia, except Australia's way around is actually that we've been seeing the story for the participation rate is even higher than it had been pre-pandemic. So actually, if you adjust for that, the unemployment rate in Australia, for example, is way below where it was pre-pandemic. So a loosening up there, yes, it should take off some inflation pressure, but also it still means it's a strong labor market, just not as robust as before.